Are you trying to figure out how to tax your limited liability company? Well, in this video, we're going to walk through what you need to consider when it comes to choosing the taxation for your LLC. All right, let's get started. Okay, so it's not uncommon when it comes to setting up an LLC to run into someone who does not realize when you create an LLC, you can determine how you would like it treated for federal tax purposes. Yeah, literally, the LLC is what we would call a hybrid entity. And it's a very popular form of conducting businesses under because of the fact that it gives you a wide range of tax solutions or tax options when it comes to how the IRS will treat that entity. So what am I referring to when I say tax options? So if I were to set up a limited liability company, I set this LLC up, I file it with the state, and I now have my limited liability company. We've got an ARC Ventures LLC that's been set up. Let's say we set this one up in Oklahoma. Now, I then will apply for an EIN number with the IRS. And when I apply for an EIN number for this LLC, I have several different options I can pick from in determining how I want this treated for federal tax purposes. Meaning this, my LLC can elect to be treated as a C corporation for federal tax purposes, which means that it's taxed at a flat 21%, and it'll file its own tax return, which is referred to as an 1120. So nothing passes down to the owners of the company. The C Corporation LLC pays tax on its income. Anything that it didn't expense out, it'll pay tax at a flat 21%. So that's one option. The second option you have is to treat it as an S corporation, which is a flow-through for federal tax purposes. So with an S corp, the entity will file an 1120S federal tax return. So this form of business entity is probably one of the most popular forms. That is, LLCs tax as S corps. You see them all the time for people who are running side gig businesses. Just maybe they're just going into business for themselves. They got a small business. They'll set it up as an S corp because there's some tax benefits from an employment tax standpoint that make this a very attractive business form for small businesses. Now, the third option you have is what we call a partnership. Okay, so a partnership files a 1065 tax return on an annual basis, and a partnership is a flow-through entity. Now, if you choose partnership, you have to have two partners. Okay, so with a C Corp, you can have one owner, S Corp, you can have one owner, but in a partnership, you have to have at least two owners. Okay, and I'll discuss some of the things we look at when we're choosing these various forms here in a moment, but I just wanted to throw this out there that if you wanted to go this route, you need to have at least two owners. And so the partnership can be beneficial in certain circumstances. Now, the fourth option you have is what is called disregarded tax status. And what does that mean? There's no tax return that is filed here. Okay, so with a disregarded entity, again, you can have at least one owner. You can only have one owner, that is. With a disregarded entity, the IRS will never ask for a tax return associated with this LLC because you told them that the member, the sole member, because it can only have one member, unless you're in a community property state, it can be husband and wife, the sole member will treat all of the income on their personal tax return as if they own the asset or they ran the activity under their own name. So the LLC legal shield is there for liability purposes, but from a tax planning standpoint, let's say that I had set up a Uber. So I'm an Uber driver and I create an LLC for my Uber driver activity. Well, that is active income. That would show up on your Schedule C of your 1040. So even though I'm running it under a limited liability company name and I'm collecting income in the name of the LLC, it all flows down onto my Schedule C as if I was just running that business in Clint's personal name. So that's what I mean by disregarded. So these are the four forms you have for a limited liability company and choosing how it's going to be taxed. Now, before I break down for you the various generally categories of activities we would run through these tax categories, I do want to impress upon you one thing that is extremely important here when you set up your LLC. So your LLC operating agreement needs to mirror whatever tax status you elect. Now, this is where people have gotten into trouble with the IRS, and that is when they get audited. The IRS will look at their operating agreement and they'll say, all right, your operating agreement was set up and it claims that your LLC is a partnership for federal tax purposes, but you chose S corporation to be treated as an S corp. Therefore, we have a problem. All right, you're invalidating your S election by your operating agreement stating that it's a partnership. And this has negative tax implications to the owners of the business. And there's been several audits around this where the service has penalized people whose operating agreements did not match their tax election. So if you've set up an operating agreement and you've made your tax election, it might be a good time for you, after you've watched this video, to go back, read your operating agreement, and say, yeah, does my operating agreement have the necessary tax provisions in there that align with my tax status? Because that is important if you're ever involved in an audit. Okay, so operating agreements, high importance when it comes to choosing your tax election as well. Now, what types of activities do we look at then for these various taxation here? So if it's a C Corp, when am I going to elect to be taxed as a C corporation for my business? So generally speaking, I choose C corporation tax status when I do not want this on my return. Okay, what do I mean this? That I don't want that business to show up on my 1040. You see, all of these right here, these three, or actually there's two, but all three, that activity shows up on your 1040. Now the S Corp and the partnership, the activity shows up through those tax returns. Now, why is this important? Well, when you're working with lenders, right, and you're applying for a loan, and you have to turn in 2 years of tax returns, 2 years of 1040s, because you're trying to qualify for an individual loan. And when they see your tax return, if they see that you have a K1 that would come from an S Corp or from a partnership, they see that activity on your return, then what they would say is, oh, we need to see those tax returns for your business as well. And so they'll scrutinize those businesses. And if those businesses are showing losses because you're expensing everything out, that could be a detriment to you in applying for that loan, because then they're concerned that maybe your business isn't making money. So whenever I'm engaging in an activity with a client and I'm asking them, all right, is this business going to be profitable? If they say, no, it's probably not going to be profitable. Okay, great. Do you borrow money? Do you tend to go out and invest in real estate? Yes, I do. Or I'm going to be looking for a loan in the near future to buy a personal residence. Well, then I'll tell you what, I don't want to set that business up as an S Corp or a partnership or disregard anything. I want to keep all that activity, those losses, locked away in a box, because that's going to look negative. You're not going to hear this from CPAs. I can tell you this because I've dealt with CPAs on this issue many a times, because they do not see past just the taxes. They don't understand that some people do invest and they want to buy a personal residence and they want to look better to lenders. And by setting up activities that show up on your 1040 that are negative to a lender, it's not helping you move forwards with your investing. So that's one of the major criteria for me in starting a business or working with someone who has a business. Hey, if you're going to be borrowing and that business is losing money, or you just don't want that activity on your return, then set it up as a C corporation. A secondary concern is that if you have a business and you're making really good money in it, let's say you're making $800,000 or more in your business, and you don't need all that money, and in fact, you're reinvesting that money back into the business, then I would choose C corporation as well for my business. Why? Because on $800,000, or let's say I leave $200,000 in there. I took out $600,000, I leave $200,000 in my business. The $600,000 that my company pays out to me, the $600K, that's taxable as ordinary income. Okay, well, it's actually active income because it comes out as a salary. It's a deduction to the company. But the $200 that I leave in there, that'll be taxed at a flat 21%. Had I been in an S Corp, it would have been taxed at 37%. So now I am saving 16%. Or $32,000 in taxes by leaving that money in the business. So if you're one that is going to continue to reinvest into your business to help it grow, consider using a C corporation, because you'll have more money left over after taxes. So those are just two criteria that I look at when I'm forming an LLC and determining its tax status for the C corporation. All right, now we get down to S Corp. What are we going to look at here with an S Corp? So if you have a small business or a side gig business, and you need all the income. So you want all of the income from this activity. So you take all the income. So if that's where you sit right now and the business is positive cash flowing, then I would definitely look at using an S corporation. And the reason why you're going to choose that is because you can save on employment taxes. Now, employment taxes mean this, that if you ran your business as a sole proprietor and you made $50,000, say as an Uber driver, well, if it was done as a sole proprietor, then the entire $50,000 is subject to 15.3% employment tax. So this is a tax, this is that Social Security, Medicare, Medicaid tax that they hit us with. Well, if I don't want to pay that 15.3% on my entire active earnings, then I'm going to set up an S Corp. And what I'm going to do then is I'm going to put myself on payroll, because as a sole proprietor, you don't have this option. Or as a partnership, you don't have this option. But if it's an S Corp, I do have it. And what it means is I can set myself up on payroll. So I say, all right, my company's going to pay me $25K in salary, and that's going to be subject to 15.3%. So I'm going to pay, say, $3,500 in taxes here on that. And then I'm going to take the other $25,000 is what we refer to as a distribution. That distribution is not subject to the 15.3%. So that's going to save me $3,500 in taxes. All right, over 10 years, that's $35,000 in taxes I saved on that little side gig Uber business that I've set up for myself. So those savings can be significant by choosing an S corporation. So again, analyze your business to make the proper determination. Now, for both of these levels right here, what am I getting at? These are active businesses. Okay, these are not passive businesses. What do I mean by passive? Well, if you own rental real estate, if you have a stock trading account, something like that, that is considered to be passive income from the terms of the Internal Revenue Code, then you want to look at using either partnership or disregarded tax status for your entities. All right, so in this case, if I had a rental real estate, that would be the perfect example of a partnership or for a disregarded structure. We're going to structure those entities when we set them up so that they're still flow through, because we want all the benefits of owning that asset and the depreciation. We want to take all that down onto our 1040, but we also want the flexibility so that if we borrow against that property, we pull money out, we won't be taxed. If we sell the asset, we don't run into adverse tax consequences here that can sometimes happen when you're in an S or a C corporation. For example, I recently spoke to someone who sold the assets of their S corporation. And unfortunately for them, in this sale, there wasn't a lot of planning we could do for them because they had appreciated assets inside of there, and they had borrowed money in the name of the business. And so when they sold the assets of the business, that loan that they'd taken out in the business name, they didn't get credit for that loan. Meaning, if you take out $200,000 to buy a home, for example, and then you sell it the next day or the next year for 250 grand. Your gain is only $50,000 because you get this basis of 200K. But when you use an S corporation, you don't get basis for what you borrow. So that's a problem. So you end up getting taxed on assets that you borrowed, and you think, wow, this seems so unfair. Well, unfortunately, it's just the way it is. So you have to be very careful in choosing the right tax status for your entity, for its particular type of business. Now, if you want to learn more about this, I would highly encourage you to go into the show notes, which is right below this video. You click on the More button and it opens it up. And I have a number of links inside of there. One of those links is for a free strategy session. You can reach out to us. You can book your own strategy session. We'll sit down with you and we'll analyze your business and explain to you how to go about setting it up from a tax standpoint. And heck, we didn't even talk about another entity, which is a traditional corporation that may actually even provide better benefits for the type of business you're looking to form. So guys, if you liked the video, be sure to hit the like button. And if you'd like to join us at one of our tax and asset protection workshops, in the show notes, there's also a link there. It's a one-day event that we teach on Saturdays, where we walk you through how to structure your assets for maximum protection. And at the same time, we explore some tax planning opportunities that are guaranteed to put more money back in your pocket. Click on that link, register now. It's completely free, and you'll get a wealth of knowledge if you just spend the day with us.